This chapter is about considerations about earnings per share. A main message is, don't treat 1 year's earnings as gospel. Quarterly and annual per share numbers get the headlines, but they're noisy. Companies can and do tweak accounting, recognize special items, or change how they count shares so a single year makes the headlines look good, even if the long-term business hasn't changed. The chapter illustrates this with Alcoa. At first glance, you see earnings per share, EPS, of $5.20 in 1970 versus $5.58 in 1969. Looks okay, but the footnotes reveal multiple EPS numbers, primary, net after special charges, and fully diluted versions that account for convertibles and warrants. Which is the real number? You can't know without reading the notes. In Alcoa's case, special charges and dilution materially change the headline multiple, price/earnings, from cheap to quite expensive. The chapter walks through the common tricks and accounting variables to watch for: dilution. Convertibles and warrants increase future share counts. Fully diluted, EPS is often the more conservative, realistic measure. Special charges, or one-time items. Companies can book big restructuring charges, write-downs, or reserves in a single year. Sometimes they truly are one-offs. Sometimes firms use them to clear the decks so subsequent years look artificially strong. Beware when non-recurring items keep repeating. Timing and tax effects. Reserving for future losses this year may create tax benefits later that inflate future reported profits. That's why you must ask how special items affect taxes in future years. Depreciation, R&D accounting, inventory methods, FIFO versus LIFO. Switching these policies can swing EPS without any real change in cash profitability. Trane, for example, improved EPS simply by returning to straight-line depreciation. Pro forma earnings. Managements love to publish adjusted results that back out costs they call non-recurring. These can be hugely misleading. The commentary bluntly says, ignore pro forma headline numbers unless you know exactly what was excluded. Pension accounting. Some companies have booked pension gains into current income by assuming higher future returns on pension assets. That can make earnings look stronger even when the operating business is weak. SBC is used as an example. Always check how much of net income comes from pension or unusual accounting gains. Capitalization versus expense. Companies sometimes capitalize costs, treat them as assets, that other firms would expense, boosting short-term profits. Global Crossing and others used capitalization to make losses disappear from the income statement. Inventory write-downs. A large write-down can be portrayed as one-time, but if the industry is deteriorating, those one-time hits can recur. Micron's repeated inventory write-downs illustrate this. So what should an investor actually do? The chapter and commentary give practical rules. 1. Average earnings. Use a multi-year average 7 to 10 years if possible to iron out the cycle. Including special items in the average usually makes sense because many of them are part of the company's operating history. 2. Measure growth properly. Estimate growth by comparing recent multi-year averages, for example 3-year average, with the comparable period a decade earlier. That gives a more robust historic growth rate than 1 or 2 years of results. 3. Normalize and focus on cash. Consider owner earnings, or cash flows rather than reported EPS. Owner earnings equals net income plus depreciation and amortization minus normal capital expenditures, and then adjust for unusual items and option dilution. Cash is harder to fake than net income. 4. Read the footnotes. This is non-negotiable. The true story is usually in the notes. Accounting policies, convertible securities, pension assumptions, related party transactions, contingent liabilities, and the like. 5. Ignore headline pro forma until validated. Treat management's adjusted numbers skeptically. Validate each adjustment yourself. 6. Watch share count trends and option overhang. Payouts from options can dramatically dilute future earnings per share. If insiders are constantly repricing options, that's a red flag. 7. Use two-part appraisal. Graham's suggested approach. A. Compute a past performance value based purely on historical averages and stability. Then, B. Apply a reasoned senior analyst adjustment for foreseeable future changes. This separates what actually happened from what you expect to happen and highlights how much guesswork you're adding. 8. If you can't determine the true earnings, don't rely on the single-year number. Either reconstruct a normalized EPS yourself or move on. The commentary adds contemporary color. Accounting gimmicks exploded in the 90s and 2000s. Aggressive revenue recognition. Quest. Capitalization tricks. Global crossing. Repeated non-recurring charges. Pension assumptions that look unrealistic. And pro forma spa wrapping of results. These examples reinforce that many headline EPS figures are fragile and sometimes engineered. So to conclude, treat per-share earnings as a starting point, not a verdict. Use multi-year averages, normalize for one-offs, prefer cash-based measures, and always read the notes. If the accounting is opaque or management keeps changing policies to suit the headline, walk away or demand a higher margin of safety. That combination, skepticism plus focus on durable cash generation, is the simplest, most effective defense against the numbers game.